Hey everyone, welcome to my channel. So today we're here to talk about, is the stock market downturn over, right? Target just lost $9 billion trying to pander to EG people and get that score up with, I believe that's with the LGBTQ community and things like that. And then you're going to see a lot of companies doing that. So now we're at a place where people aren't taking their money out of the market based on what projections are for money, but now based on political beliefs and systems like that. So now that emotional factor is coming into play. And a lot of people are saying you can't really target two different audiences and then please both audiences or either audience. I don't believe any audience is going to be content with threading the needle instead of truly pushing one way versus the other. And so a lot of investors are saying stick to what has worked for you versus the unknown territory, which is understandable from a business perspective, but we'll see how it shapes out and we'll see what route a lot of these businesses go down or go up when it comes to different initiatives and different campaigns that they're trying to push. But the Fed has raised the debt ceiling. We all knew that this was going to happen. We all knew that Americans were not going to default on their debts. And so the Fed has come to an agreement. They have raised the debt ceiling. And so the stock market did not take a nosedive as we all anticipated would happen. And the only thing that will make the stock market take a nosedive now is an increase in interest rates, which will essentially knock down the push up the unemployment and slow down spending. So if you invest in stuff like Target, Walmart, things like that, there's going to be less money to go around. And so the businesses are less profitable. And when you increase interest rates, what is also happening is you're increasing the interest rate on savings accounts. So when you're getting 4%, almost 4.5%, or you can get a CD right now at 5.05% or even 5.15%, it is ridiculous to assume that you're going to take on risk versus getting a 5% return with zero risk. I mean, that is literally an investment at this point. And when stocks continue to plummet while interest rates are going up, if interest rates hit 6.5% to 7%, there may be zero reason to invest and just put all your money in a high interest savings account. And that is literally an investment at this point, and it's with zero risk. I think that rate of return is something that you simply would not get in the stock market. Zero risk, all reward. But at the same time, you buying low in the stock market now is going to allow you to shoot all the way up. You're going to see 22%, 30%, 40% returns like we did during former President Trump's era. I had a 38% return one year and then 22% return the next year. And so chasing the quick 4, 5, 6, 7% return can be disastrous, but it is also a good safe bet, and it is better than nothing. So is the stock market downturn over? Well, again, I'm just a random guy on YouTube and a random guy on Rumble. But what I would say is it is not over. And here's why I'd say it's not over. So in certain markets, especially in the Midwest, housing prices are still shooting up. And I don't want to say that interest rates are only for the housing market, because that would be a simplistic mindset, and that does not encompass all that interest rates are covering. They cover auto loans. They cover personal loans. They cover home equity lines of credit. They cover credit cards. So everything is covered with these high interest rates that the Fed is pushing, right? So it affects many things. Repos are on the rise. There's over 300 repos per day, 300 repo requests per day, and only about 150 of them are being taken. And Toyota is now incentivizing repo personnel to repo cars with a $400 incentive for Toyotas. So 300 per day, 300 requests, and only 150 acceptance is not a lot. We're not going to see many cars hitting a lot. This is going to be about 2 years of repos going through the ringer in order for us to see a substantial amount of used cars back in the market, on top of expanding upon new vehicles hitting the market, especially as they're trying to go electric. So that's another hurdle. If everything was still gas-based, we would see a lot more volume in vehicles getting pumped out. But because a lot of these vehicle manufacturers are switching to electric and hybrid models, this is new for them. In order to ramp up, you need to have the skill, the training, and the expertise, the experience to push out that type of innovation. And with high interest rates, the pressure is going to be on to increase volume in order to meet the demand as well. So we're going to have a lot of stressed workers in these car industries and a lot of layoffs as well. So now you're going to have less people doing a lot more on top of that. So as long as Toyota is going to be okay because their brand is selling like hot cakes, Honda is also going to be okay. Their brand is selling like hot cakes. And Tesla is going to be okay because their brand is selling like hot cakes. All in the top 5 in cars. And so with the stock market, I predict that it will go down a little bit more. And the reason why I say that is because I believe that the Fed will look at the interest rates in June, and they will say, okay, I see some cracks in the market, but a little bit more of a push will get us over the hump. And I believe that the Fed will raise it ever so slightly, just a little bit, and the stock market will take another downturn. Will it be the last? I am unsure of that. And even if it's not interest rates that do it, there will be another factor that lowers the stock market at least one more time this year prior to it getting better. And we all know December is never a good month for the stock market. So you can account for that also being a bad month in the stock market. And that is, when I say a bad month, it's a good month for me because I love December. I always invest as much as I can in December for the best discounts going into next year. And it's probably why my account is still in the green, even though it's been a horrible year in the stock market. My account is still in the green because I invest every single December and get those cheap, deep discounts. The reason why December is always going to be cheap is because people take money out. They're going on vacation to hotter climates. They're going gift present shopping and they just didn't have the money saved. So they're going into their savings account and they believe that they're going to replenish their stocks in February when they get taxes, in April when they get their taxes. And so that's why I love December and I just wait for that rise right around February, March, and April. And so we're hitting that time of the year where everybody's going out spending money. It's the summer months. We're going to see a lot of vacations. We're going to see the stock market go down a bit, not a lot, because we do have some experienced investors who are not seasonal like that. But in December, we'll definitely see a more significant drop. And so that's what I'm accounting for as someone who has been investing in the stock market for almost a decade now. So if you like this video, make sure you leave a like, comment, and subscribe. You know I post every single day at 8 a.m. daily, and I can't wait to see you on the next one. Peace.